When you divide the Dow price by the weight of gold, you get less than 17 ounces, which is about where it has been for quite some time. Maybe even a little bit higher. The all-time record high for the Dow in terms of gold was in 2000, which was at the start of the millennium. The Dow actually got above 40 ounces of gold because, remember, at the time gold was around 300, and it's now above 2,400. Therefore, during that time, gold has increased far more than the Dow. However, if you really want to go all the way back to some previous Dow heights, the Dow Jones 1929 reached its top around 20 ounces of gold, just before the notorious stock market crash. Now, when the market crashed, the Dow fell to 1932, which is too close to 1-to-1, but not quite 1-to-1 with gold. The Dow took a long time to recover to that high and didn't really reach a new high before collapsing once more in 1966, putting us below 1932 and closer to 1-1. However, we were not quite 1-to-1, but we were below 2-to-1 in both situations. For the Dow to be 2-to-1 with gold, it would have to be 20,000 ounces if it stays around 40,000. However, we may not stay at 40,000 and instead drop to 30,000, in which case gold would only need to be 15,000 an ounce rather than 20,000. We'll see, but we got close, and this next bear market might actually take us all the way down. Perhaps we will even reach 1. Well, what if the Dow hits 100,000? What if inflation is so high that we have a 100,000 downturn? Does it imply everyone is wealthy? No, not even at $50,000 per ounce of gold, as that would only allow you to acquire 2 ounces, although with the current Dow Jones, you can afford nearly 17 ounces. The U.S. government's activities, according to Peter Schiff, might drive gold prices to $50,000 an ounce. This week, the metal almost hit $2,400, highlighting the sharp decline from 2000, when the Dow had almost 40 ounces of gold, to today's approximately 17 ounces. This is something you have to keep in perspective because inflation creates an illusion of prosperity and wealth, which is another reason why the government loves inflation so much. Essentially, partners in inflation, the government derives all kinds of hidden benefits. Schiff explains that if inflation continues unchecked, gold could reach $50,000 while the Dow hits 100,000, exposing the illusion of prosperity created by inflation. But as you can see, everything the government does is backed by inflation, even though it never wants to acknowledge this or say it aloud. Indeed, one could argue that inflation serves as the government's god or deity. They almost worship it, but they never mention it by name. That is, not in the context of what they use it for. As a result, when the public becomes agitated about rising prices and declining living standards, the government will discuss inflation, but it will do so as though it's an external event that is entirely outside of their control. Biden, for example, claims that inflation is the result of corporate greed, which I addressed in the previous video as though corporations weren't just a bunch of selfless people. These are the inflation chickens coming home to roost. This is how the government has been financing its budget deficits. This is how the government plays Santa Claus. This is how the voter gets something for nothing. Well, you don't get something for nothing. It wasn't until a few years ago that they finally found their inner Grinch and realized that they were being too nice and leaving all this money on the table. So now it was time to put the screws on the consumer. And it just so happened to coincide with Biden being the president, right? Individuals are now paying for all of that at much higher prices. But aside from that, by inflating nominal numbers and then not measuring them accurately, the CPI is purposefully designed to capture only a portion of the impact of inflation on prices, allowing the government to pretend that things are improving because more people are earning more money, increasing the value of people's homes, salaries, net worths, and stock portfolios. Not too long ago, it was difficult to make $100,000 annually. That wasn't a big salary when I was younger. It isn't a big salary now, but people still think that because they are making $100,000 a year, they must be doing well. The government can also deceive people into believing that they are wealthy because they own expensive homes, even though they aren't getting richer because their money is losing value. In keeping with the conversation, Peter Schiff talks about how the dollar's value has sharply decreased as a result of previous centuries' inflation. He points out that gold cost $20 an ounce in the 1800s and the first part of the 1900s, but today is over $2,400 because to Federal Reserve policy and government spending. According to Schiff, although the Dow Jones nominal value has climbed, its true gold value has declined. In 1929, the Dow was valued at 20 ounces of gold. Today, it is worth less than 17 ounces. Since prices must rise to reflect falling value of money, inflation obscures real economic prosperity and creates the appearance of affluence, as evidenced by the Dow Jones. For over 150 years, from the time of our nation's founding and the signing of the Constitution until Roosevelt devalued it in the 1930s, $20 was all that was needed to purchase an ounce of gold. However, with the Federal Reserve and all of the government spending, it now takes more than $2,400 to purchase an ounce of gold. That is the amount of value that the dollar has lost. However, the dollar has lost value in more ways than one. For example, it is now worth far more to purchase the Dow Jones than it is to purchase an ounce of gold. It's true that you need a lot more money to buy anything, but that doesn't mean the Dow Jones has increased in value. In 1929, 20 ounces of gold were worth, and today's value is less than 17 ounces of gold. Therefore, in actuality, the Dow is cheaper than it was in 1929. However, that was a peak, the top of a bubble, and the Dow was extremely expensive. So it's not really a fair comparison to say that the Dow has increased in value when I choose such an overpriced period of time. However, it does put things into perspective by showing that if you buy during a bubble or when the Dow is expensive, it's not a good deal. In general, stocks are a good investment if you buy them at a good price and you can get a good return. But if you buy it in a peak, well, that's not a good long-term investment. Of course, it's difficult to tell when you're buying at a peak. So when you buy there, everyone assumes that the market will continue rising, which is why they buy. However, during the manic period at the end of the 1920s, which coincided with the Fed, you know that the Fed caused that bubble. Alan Greenspan, for example, blames the Fed for the stock market bubble of the 1920s. Before he became Fed chairman, he was very good at criticizing other central bankers for their mistakes, such as keeping interest rates too low and inflating bubbles. However, once he became Fed chairman, he simply carried out the actions that he had previously criticized previous Fed chairmen for. However, individuals who fell victim to the market and bought Dow shares for 20 ounces of gold now have less value than they did then. The Dow has changed, and there are now very few stocks. Peter comments, I don't know how many of the 1929 Dow 30 are still standing. Maybe 2 or 3. I kind of lie these things, so I really didn't realize that I was G to talk about this. But I would have been prepared had I done my research beforehand. I actually forget that I could have checked it up before the podcast. I may have looked it up, but I'm aware that the most of the businesses have closed. The point is that the Dow is lower now than it was at that high point. If you held the Dow Jones for less than a century, it won't be a century until 2029. So they will have to replace them with new companies. So it's not an apple-to-apple situation. Rather, it's different fruits in the basket. Therefore, if you were a small child and were born in 1929, your parents or grandparents gave you 100 shares of the Dow, or whatever, and you still own them today and you're still alive. You made money because you earned dividends. It's been over 90 years, but not quite 100. However, the idea is that if you sold the Dow today, you would receive fewer ounces of gold, a little less than what you would have received if you had sold those shares 90 years ago at that time, assuming you didn't reinvest the dividends. Let's say you have been using the dividends for the last 90 years and you only have the Dow. That indicates that, yes, you now receive significantly more money, more than 20 times as much, to be exact. But that doesn't mean that you receive less because the value of the dollar has changed since 1929. It doesn't just mean that you now need 100 times more money to purchase an ounce of gold. You need 100 times more money to purchase nearly anything, as prices have increased. It is not an accident nor a normal consequence of capitalism. Rather, inflation is the result of our government devaluing our currency. The opposite is true of capitalism. As I mentioned earlier, the CPI lost 50% of its value between 1800 and 1900. This is what capitalism does. The next 100 years saw a sharp increase in prices. This is what socialism, the government, and central banking do. These factors mixed with capitalism and distorted and diluted it. As a result, we are currently dealing with the consequences. Peter Schiff emphasized how inflation has diminished the value of the dollar, demonstrating that even if the Dow Jones has increased nominally, its real value in gold has decreased since 1929. He also emphasized that inflation is a result of Federal Reserve and government policies that give the impression of riches. In conclusion, the potential shift of the largest holder of US Treasuries into gold, as Peter Schiff suggests, could indeed set off a monumental revaluation of gold prices, potentially driving them to the astonishing $50,000 mark. This scenario isn't just a wild prediction. It's grounded in significant economic factors and historical precedents. The sheer scale of U.S. debt and the global economic climate have created a precarious situation where the demand for a stable, tangible asset like gold could skyrocket. As countries, particularly those with substantial reserves of U.S. Treasuries, reassess their strategies amidst fluctuating trust in the U.S. dollar, the pivot to gold could become an increasingly attractive option. This strategic move would not only safeguard their assets against potential devaluation, but also set a precedent that could ripple through the global financial system. Schiff's analysis highlights a critical juncture where economic realities intersect with market perceptions, suggesting that gold's intrinsic value and historical role as a safe haven could once again come to the forefront of international finance. Furthermore, the implications of such a shift are profound. A surge in gold prices to $50,000 would not just reflect a change in the valuation of a commodity, but would signify a broader realignment of economic power and currency stability. Investors and governments alike would be forced to reconsider their portfolios, potentially triggering a cascade of financial adjustments worldwide. This potential gold rush underscores the enduring allure of gold as a repository of wealth and a hedge against uncertainty, especially in times of economic turbulence. Schiff's insights prompt us to think critically about the future of global finance and the role that precious metals could play in it. While such predictions often attract skepticism, they also offer a valuable perspective on risk management and asset diversification. For investors, understanding these dynamics is crucial. It's not just about following trends, but about comprehending the underlying economic forces that drive these trends. The potential revaluation of gold presents both an opportunity and a challenge, urging investors to stay informed and prepared. As we navigate these uncertain times, it's essential to stay updated with expert analyses and insights. By understanding the factors that could propel gold to unprecedented heights, investors can make more informed decisions and strategically position themselves to benefit from these shifts. The dynamics of global finance are constantly evolving, and being proactive is key to navigating this complex landscape. If you found this discussion insightful and want to stay ahead with more expert analyses and financial tutorials, make sure to like this video, share it with your friends, and subscribe to our channel, Investing Tutorial. Your support helps us bring you more valuable content and keeps you informed about the latest trends and strategies in the world of investing. Remember to press the notification bell to ensure that you never overlook any updates. I appreciate you watching, and I hope to see you in the future one.